in
Welcome back, everyone. My name is Michael LeBlanc, Senior Portfolio Manager at Canaccord Genuity Wealth Management. And thanks for joining us here again this week, where we cover off everything that we see in the markets last week and then what's coming up this week. And there's been a lot going on, obviously, if you've been following the markets. So we'll bring you up to date on what we're seeing there. We were off last week. I was down in Vegas, believe it or not, one of our first conferences back. We had a Canadian microcap conference down there where I had a keynote speak there for a couple of sessions. It was great to kind of get out and see people in person again. We'll actually have some videos from that conference if you're interested. We'll be posting them to our site at mikeonmoney.com. If you have any questions, you can also contact us through there or any updates. Please feel free to give us any feedback at all. We'd love to hear from you. And with that, as always, the information we present on here is for information purposes only. Do reach out to us with any of your questions that pertain to your particular situation or portfolios, or do your own due diligence to make sure that you're taking appropriate actions within there. So with that, let's dive into what we're seeing in the economy coming up this week. We're looking for the small business optimism for April numbers. Obviously, expected the numbers to be a little bit off with what's been going on late April, early May with the inflation numbers and continued rise in interest rates as we saw another rate hike by the U.S. to match. Well, the Canadian one was earlier than the U.S., but they were pretty much to go step in step. And we're also looking for the Secretary of Treasury, Janet Yellen, to testify to the Senate Committee on the Financial Stability Oversight Council's annual report. So maybe a little bit more insight into what they're seeing for the rest of the year as far as the rate hikes go. We saw the stock futures rebound a little bit this morning. That was the futures, the pre-market. Obviously, the market opened a bit positive off of that, but then retracted into negative territory pretty quickly. It's moving closer to flat for the day. NASDAQ up a little bit, but definitely the negative sentiment continuing off of yesterday and Friday's pullbacks. We're definitely through correction territory in the markets. And looking or potentially heading towards a crash in the markets, which would be a negative 20%. So we're still seeing a lot of volatility in the markets out there. Obviously, main theme that continues is inflation and interest rates. A lot of other noise being fed into there. But those are the main themes we continue to look at. Slowing global growth because of that. And inflation soaring to a bit higher than the Fed had hoped for after the interest rates, but we do have the Ukraine situation continuing to tighten the supply chains and pricing, especially in commodities out there, which is pushing up those inflation numbers even further, which of course raises the risk of more interest rates or more aggressive interest rates moving forward. We are hearing whispers, as I mentioned, of the S&P 500 moving into bear territory. That's that 20% decline. We've already gone through, I haven't seen the latest numbers as of this morning, but I think we were through something like 12 or 14% decline already. As the optimism wanes, especially around some of the big names that rallied quite a bit in 2021. As those valuations correct even further, and people start to slow down, whether it's slow down purchasing, whether it's home pricing or just general purchases. We're seeing information come in out of the retailers that people in 2021 people were moving towards the more expensive options out there because of the supply chains. They were given paying a little bit more to get maybe extra features or the bigger more expensive models of what they were buying, but we're actually seeing that retrace in 2022 where people are actually favoring for the cheaper models or the lower cost models. out there as things are continuing, as prices continue to rise, especially if you look at fuel, gasoline hitting all-time highs across the country. I know we often see in the reports that, Toronto saying, oh, they're approaching the $2 liter range. Of course, here in BC, we're at 2.20 a liter range. In fact, I think I've seen it as high as 2.22 at one point. So definitely over the $2 range already in BC. COVID vaccine makers are shifting over to boosters. Just basically the run up or the initial shots, which are of course have higher dosage than the boosters. Pretty much done. Those who haven't got it, doesn't look like they're really anxious to go out to get it. Anyway, that's not the big market. Now they're focusing on their all their marketing and development onto more competitive boosters for the annual booster that will look like we'll be looking at, and they're trying to get the effectiveness of those boosters up to about 18 months, which would be ideal, so we wouldn't have to look at anything more than an annual booster, much like we do with the flu shot out there. Other news in the U.S., the U.S. wholesale inventories had a good, strong rise. For the first quarter, GDP is seen to be revised slightly up on that news, and that is good news in that it looks like the supply chains in certain areas are certainly are improving and moving in the right direction. Obviously, I think commodity base is still a concern, and the Fed may have to carry the bulk of the burden after to hit their inflation goal of 2%. To really get inflation to turn over. Obviously, the markets are shifting. The general economy is moving. Early stages yet, but they're trying to bring down those prices, bring down inflation to get within that 2 to 3% target range that the U.S. Fed and same with the Canadian Central Bank to get into within that range again. U.S. profit forecasts are weakening as companies are also feeling the effects of the inflation risk. More and more the surge in oil prices has caused increased shipping costs, and of course the supplies that they buy. They've seen the raw material costs go up and interest rates. So a lot of companies will buy on credit for their raw materials, turn it around into a product, and then sell it off. Is pretty much how they finance their businesses, and with the rising cost of interest is increasing the operating or their overall expenditures. So more and more we're seeing that those earnings forecasts being revised or coming a little bit below market expectations, which is also leading to some of the pricing we're seeing in the stock market out there. The U.S. SEC has extended its comment period on climate risk proposals. So we talked about this about a month ago. If you follow this, the U.S. SEC, has put together a proposal and gone to the public for comment. They've extended now that period to June 17th, basically looking to require U.S. listed companies to disclose a range of climate-related risk and greenhouse emissions data about their operations. So this just goes to the environmental impact of investing, and for those who wish to limit that impact in their portfolio by supporting companies who are being greener. But we're also seeing a lot of the pension funds out there definitely asking for that or requiring it of their pension funds to only focus on companies that are being more environmentally responsible. So more and more as we see that, we're going to see more regulation around ESG. My apologies. As more funds look to do that, and more investors are looking to focus their portfolios on that. So whether it be reporting changes like this, or even just standards for companies to report, or for portfolios to manage to, because right now it is still a very gray area as to what constitutes being environmental, socially, or governance responsibility. A lot of different people have different opinions of what makes a company ESG. and whether it should be in a portfolio or not. So we'll see more and more probably standards to come out on those as time moves on. Let's take a look at what's coming up this week. Coming up in the U.S. Fed Reserve President, as I mentioned, is going to be speaking and hopefully getting some clues around the next path a bunch of interest rate hikes and what that looks like. We'll still see some earnings out there. EA Arts, or Electronic Arts, in the video gaming environment, is expected to show a rise in fourth quarter revenue. They had a couple of new games or titles out, Apex Legends and FIFA, which are updates to very successful previous launches. Peloton is also expected to post this week, but a wider loss. If you've been following the Peloton story, so Peloton rose to fame during the pandemic closures as kind of the home interactive gym, if you will. People were buying their fitness equipment, mainly their bikes, and working out at home when all the gyms were closed. And really the market kind of priced them in that they were going to continue that same growth line. Obviously a very difficult growth line to maintain. Even if people weren't going back to the gyms, to continue to sell more and more equipment and get more and more subscribers to their service was pretty lofty. And obviously, as things have reopened, we've seen drops in sales and subscription as people are returning to the gyms, and investors are looking for, better forecasts of kind of what their yearly growth or year-over-year growth expectations should be. And we've even seen some rumors, and only rumors, that there might be some companies out there looking at taking out Peloton and integrating it into their services. And names have been thrown around that, Nike might want to get into the space. We've also seen Amazon move in that space, and of course Apple Fitness was launched. So there's quite a few competitors out there. Other top news, Elon Musk's $44 billion Twitter deal might be at risk of repricing. So obviously we've seen weakness in the markets around the price of Twitter. So basically his $44 billion offer was roughly just over $54 a share for Twitter, which was a premium of its price. It did rise up. And normally when we see these kinds of offers, the takeout bids, the market tends to move in line with the takeout price. So, we would expect Twitter to be trading around that $54 level, where when Musk closes the deal, shareholders get that value. But we've actually seen the stock price retreat in actually sub 48, kind of between around 48, sub 48 over the recent weeks. Kind of messaging to investors that they don't know if they don't have high confidence that this deal is going to close, or if it does, whether it closes at that price. So Elon Musk does have a $1 billion breakup fee if he decides to change the deal or back out of the deal. But given how much the shares in Tesla fell on the announcement that he was going to do that, the $1 billion he would definitely make up in Tesla value, and or if he were to reprice it below the $44 billion deal, if he repriced it at 40 billion or 42 billion, obviously paying the $1 billion breakup fee would be in his interest. So the market is basically saying they don't have confidence that this deal is going through at the $54 price range. So if you're playing that spread, I'd be a little cautious around that. Rivian price slipped about 14% to hit a new low on the report that Ford was going to sell its interest or its stake in the electric car maker. If you're not familiar with Rivian's a new entrant to the electric vehicle markets, bringing in mostly pickup trucks and some commercial trucking or large truck vehicles. They've been pretty slow to get to market with their product. They had a few hiccups along the way, lost the CEO in the process. And now just as they're coming to market, we're seeing Ford back out of their ownership in the company. So we're seeing some downward pressure on their price. Now, that being said, there's been downward pressure on their price and most the EV market out there, as that supply chain has been squeezed harder and harder for the metals that go into these cars and vehicles, and also on the chip side. Although the chip supply chain seems to be improving a little bit, there's still a lot of pressure on manufacturers to be able to get access and get their vehicles off the assembly lines and into people's hands. Biden has unveiled a pact with the internet companies to reduce prices overall. So 20 internet providers, including Verizon, Comcast, and AT&T, have committed to cutting prices or increasing their internet speeds for millions of low-income families throughout the United States. And hopefully we'll see that trickle outside the United States and into Canada as well, as that market heats up in competition. As more and more people rely on streaming and internet services at home, even beyond kind of your cell phone use, but for your entertainment, for your Netflix, or for your any other streaming content that you might have, as people decouple from the traditional cable packages that they might have at home. Uber is looking to cut costs as well. They're going to slow down hiring, according to the CEO, scale back and reduce expenditures. They've been hit pretty hard through the pandemic, not just with people getting out less, but if you followed, almost a year ago, or maybe more than a year ago now, Uber faced, especially in California, it was at the forefront of this gig worker lawsuit versus employees. So are their drivers contract workers or employees, which have a very different cost structure for the companies to manage people as employees versus contract workers. We also saw some European markets also testing those laws. So Uber's looking to adjust their cost structure in order to continue to serve those markets and try to turn a profit. So we'll see more and more of that likely to come from the any of the companies that are playing in that what's called gig worker market or contractor market, where their employees are technically not employees and obviously carry less financial burden for the parent companies. Philip Morris is in talks to buy a smaller rival, Swedish Match. So if you're not familiar, Philip Morris, one of the largest tobacco and cigarette companies in the world, one of the main brands being Marlboro, is looking to buy up Swedish Match amid rising global scrutiny on the sale of traditional cigarettes and moving more and more into the smoke-free, or often called vape products, as they look to continue to maintain market share for the smokeless and the traditional cigarette markets. On the Canadian front, Canada's antitrust agency is actually seeking to block the Rogers-Shaw merger. So, again, just over a year ago, Rogers looking to take over Shaw Communications and kind of unify the country. Rogers was predominantly a service provider for Eastern or Ontario, East Canada, and Shaw in the West. Well, certainly for the home cable and internet services. They both went countrywide with their mobile service, so you can get mobile phones in the West, and Shaw's Freedom Phone service in the East, as they expanded across the country. But they kind of still had this East-West agreement on the home services. So Roger was looking to take over Shaw and have one big global competitor to the larger TELUS and Bell services. But the antitrust agency is looking at that merger and say it would lead to less competition, so there'll be less choices for Canadians. That doesn't mean the deal is dead. I know Rogers has been looking at selling off the Freedom Mobiles company, maybe to an independent, to maintain another provider or another player in that market and just expand out their Rogers and the Rogers mobile service across Canada, and just take over more of the cable and internet services. So we'll see, keep an eye on that. But obviously the Shaw stock taking a bigger hit on that news. Rogers actually had a slight uptick on that news. Of course, the buyer when a deal falls through like that, the buyer tends to tick up because they don't have to spend the money, and the Shaw being the one being acquired goes down because they're not going to they may not realize that share value if the deal doesn't close. So we'll have to keep a close eye on that. Suncor CEO Mark Little is facing some scrutiny from some activists. Basically, what we've seen is Suncor since 2014 has had on-the-job fatalities of 12, which is the worst record among Canadian peers, with their most recent one with 2 trucks crashing in the oil sands mines near northern Alberta, killing 1 person, and the CEO issuing a mea culpa, basically, admitting fault, or the company admitted fault in the accident. So there are definitely going to be a bit more scrutiny around their operations and safety measures. So as a holding within our portfolios, we'll take a close look at what they're doing there for sure. Canada's RBC to hike their base salaries for some employees by about 3%. And I think most firms are looking at salaries for staff, just given what we've seen in the jump of living costs and expenses. And that'll be a trend we see moving forward. Value of Canada's building permits was down just over 9% in March. So we've definitely started to see a slowdown in the real estate. We mentioned to it a couple of weeks ago that, on the buy-in front, the volumes are off dramatically on a year-over-year basis. And even compared to, last quarter, the same quarter last year. And pricing is starting to soften, and now we're seeing new builds or building permits going down. So good news if you want to do rent or build, where we've seen a lot of pressure on the pricing, upward pressure, obviously, of pricing on materials, but also difficulty to try to get the trades and people to do those builds or renovations. Wait times have been drawn out for quite a while, so we might see improvements on that. On the M&A front, on the oil and gas front, with the oil price still staying above $100 a barrel, and as I mentioned, weekly, that supply line versus demand still remains a bit weak on the supply side. More and more companies out there trying to bring more supply to market. So CGX and Frontera say that they've been able to find a gas condensation area in overseas in an offshore block that they are bringing some light oil and gas to the market, and hopefully replace some of that supply shortage, especially with the continued conflict in Russia, putting pressure on that. On the foreign exchange front, pretty much what we've seen is strength in the US dollar, that flight to safety. That theme is going to continue. Even if we see a moderate recovery in equities, we don't see that there'd be a sell-off necessarily in the dollar until we really see that inflationary number turn over. So it'll continue to stay pretty strong on the US front. The Canadian dollar is held in there with our interest rate hikes and strong oil, and we expect that to continue as well. And of course, since the beginning of the year on the 10-year bond yield, we've seen about a 1.6% increase in those yields as investors are really reassessing the valuations on those technology and growth stocks that had the big boom last year, as their cost will continue to rise with higher interest rates. On the commodity front, gold prices stayed steady in Europe. Basically holding in there with inflation. Not much moving there. As mentioned, oil staying just above $100 a barrel, and copper and zinc both had a slight increase of about 1%, as anything commodity bases continuing to stay pretty strong over this period, and will likely for the next quarter as well. So with that, that's pretty much all I have for you this week. As always, send in your questions. If you have anything, go to mikeonmoney.com. We'll definitely keep you up to date on what's going on in this carnage out there. If you are looking to invest, it's, just as we've always said, there's nothing wrong with gradually dollar cost averaging in. Definitely these, on these really down days, it will take, some bravery to put your toe into the market. But I don't think at these levels, depending on what you're buying, definitely I'd be focusing more on cash flow companies. We definitely like things that pay very strong dividends. And of course, the dividend rates are going up as stock prices go down. So there are some pretty good values out there to slowly start picking up some dividend stocks. You can always buy a little bit more if it should continue to weaken. But the good thing about those is where we're seeing, even around the 6% range on the dividends, sometimes higher. While you wait for this carnage to pass over, you're getting paid that 6% dividend yield on some quality companies out there. So if you're looking for some ideas, do reach out to us. We certainly haven't deployed all our cash that we've had on the sidelines. As I said, we're just started to slowly dip our toes in on some unique targeted positions that we quite like in the portfolios. But we will continue to implement that strategy as this pullback plays out, and if we lead into a crash over the next month or so. So with that, again, thank you very much for joining us. I wish you all well and hope to talk to you soon. Take care now. Bye.